It's not quite as busy as last week, when around a third of the FTSE 100 published interim results, released a trading update, or hosted an annual general meeting. But another dozen or so members of the UK's premier stock market index will be making a statement of some kind or another in the week ahead. That adds to a busy slate of macroeconomic news, which will include the latest Purchasing Managers' Indices, or PMIs, for the UK, Europe, Asia and America on 3rd, 4th and 5th of August, and a Bank of England interest rate decision on Thursday the 6th. However, the real headline grabber from a top-down perspective will once more be American jobs, when the latest non-farm payrolls and unemployment statistics are released on Friday the 7th of August. Now, the number of new COVID-19 cases in America began to go up in July once more, prompting a number of states to return to lockdown to some degree or other. The worry has to be that this starts to hit American jobs again, so these numbers will be important, even if the last two batches have been a bit of a mess, as much for how they're collated as what they represent. Remember that the US Bureau for Labour Statistics got itself into a bit of a tangle. In May's numbers, the BLS admitted it made errors in the compilation of the data, but then not corrected them. This was because the BLS survey interviewers were told to classify workers on furlough or absent from work owing to COVID-19 for temporary reasons as unemployed. But it turns out that not everybody was, with some still registered as having a job. That caused a real stir, not least because of accusations that the BLS was understating the jobless rate to make America's economy look better than it really was. Now, the same happened in June, albeit to a much lower degree. The result was that the official American unemployment rate went down to 11.1%, although that was still higher than the modern-day peaks seen during the recessions of 1982 and 2007 to 2009. Anyway, on paper, America created 4.8 million jobs in June after 2.7 million in May. Welcome after April's appalling 20.8 million job losses. Let's see what July brought, where the Economist's consensus forecast is looking for the addition of 2.2 million more jobs. Now, clearly the higher the number, the better it is for America's economy and potentially corporate earnings. Although the worse the number, the longer interest rates will remain low and the more stimulus the US Federal Reserve and Congress might provide, which the stock market might actually quite like. In conclusion, how US share prices will respond to the latest jobs report is frankly anyone's guess. Turning back to Britain's corporate news, announcements which may be worthy of note include those from the following. On Monday the 3rd of August, megabank HSBC and insurer Hiscox, drinks giant Diageo, gold miner Centamin and another insurer Direct Line on the 4th, real estate investment trust Segro, life insurer Legal & General, Coca-Cola Hellenic Bottling and bookmaker William Hill on the 5th, two more insurers, Aviva and Phoenix Group, broadcaster ITV, packager Mondi and trader and miner Glencore on the 6th, and to finish off the week on Friday the 7th of August, fund manager Standard Life Aberdeen and Hikma Pharmaceuticals. But for me, the stock capable of causing the biggest fuss in the week ahead is BP. The oil major is scheduled to release its second quarter results on Tuesday the 4th of August. Now, you probably won't be surprised to learn that BP's share price has gone through the floor in the last 12 months, falling more than 40%, twice as much as the fall suffered by the FTSE All Share and FTSE 100 over the same period. Spring's collapse in the oil price, thanks to COVID-19 and the recession hitting demand, as well as galloping increases in supply from shale in America, are the main reasons for BP's share price woes. But even before this year, the markets had been worrying about oil demand and oversupply, thanks to the global push towards a carbon-neutral future and the rise of renewable energy sources. Such concerns prompted fears the big oil firms would be left with weaker cash flow and also perhaps stranded assets that they wouldn't be able to fully monetize, hitting their ability to pay dividends. New BP boss Bernard Looney, who took over in February, is already looking to reposition BP and ensure it's a so-called net zero company by 2050. He's got a big strategy presentation planned for this in the autumn. Analysts will be looking for comments about that nevertheless in these second quarter numbers too, not least because they're going to be pretty ugly. Back in June, when BP cut its long-term oil and gas price assumption, Mr. Looney warned that BP would write off between $13 and $17.5 billion worth of production equipment and oil field exploration assets in the quarter. So that will leave the firm in loss at the net level or the bottom line for the second quarter in a row. Q1's loss was mainly down to inventory write-downs, and on an underlying basis, BP did make a profit, albeit a reduced one. Analysts will also look to the trends in performance from the upstream assets, exploration and production, and the downstream ones, refining, chemicals and petrol stations. Oil and gas prices both weakened further in Q2, so it'd be no shock if upstream made a loss just as it did in late 2015 and early 2016. That could pressure cash flow and would in turn pose more questions about the dividend. Shell cut its dividend by 2/3 in Q1, but BP held firm at 10.5 US cents, and if BP sticks to that for the next 3 quarters, it will be the single biggest dividend payer in the FTSE 100 at around £6.7 billion. That number leaves BP shares on a forward yield of around 10%, which some argue may be in too good to be true territory, for 3 reasons. First, Mr. Ballooney is looking to reshape BP, and that will cost money. Second, cash flows only cover the dividend payment twice in the last 5 years, and it didn't do so in Q1 either. And finally, BP continues to pile up debt, despite disposals, the latest one of which is its petrochemicals business to INEOS. While a net debt to equity or gearing ratio of 56% at the end of Q1 was far from serious, BP's net debt position, excluding its pension deficit, has steadily crept up from $16 billion in December 2005 to $51 billion at the end of the first quarter, thanks to acquisitions, capital investment, oil's failure to get back to its highs, and also a boatload of buybacks and dividend payments. Let's see what Mr. Looney and his colleagues have to say, but we may be at the stage, according to some, where an unchanged dividend would be a bigger surprise than a cut. I hope that you and your families are all in good health and good spirits during these difficult times. Thank you for listening, and I look forward to talking to you again next week.